Well, it's not so much the year of living dangerously for Australian investors as the year of going nowhere. The All Ords is precisely where it was 12 months ago. And just like 12 months ago, things are very delicately balanced. Neil Woolrich caught up with some leading investors to see how they're seeing things and where they'd be placing their bets.
Lights, cameras, but where's the action? Just as retailers and shoppers get ready for Christmas, Canberra's statistical boffins are taking their own snapshots of the Australian economy. And the picture that's emerging is far from rosy. GDP growth slowed to a crawl in the September quarter, and retail sales fell by an alarming 1% in October.
Here we are in the beginning of December and we're already in sale mode. That's the indication of how tough it is out there.
Richard Robertson has been running Ted's Cameras for nearly 40 years, and his view of the economy is as gloomy as it's ever been.
Unfortunately, we've already lost thousands of small mum and dad type businesses in the photo finishing area, and the smaller camera stores are just finding it that much harder to compete. If you're not aligned with a major buying group, you're going to find it very, very hard to compete, especially with this online onslaught with the lower prices that's generating right now.
And just as consumers have been reluctant to loosen the purse strings this year, so too share investors have been treading warily, with local and international markets going sideways over the past 12 months. However, some of Australia's leading stock pickers think it will be a different story in 2011.
We actually think the risk in the markets is dramatically less than it's been at many times over the last 3 years. So from a risk perspective, we think that the equity markets are pretty healthy at the moment, but there's a lot of uncertainty. So we would say it's a relatively safe time to be investing, but people have to expect a bit of volatility with the uncertainty.
I think these recent figures from the PMIs around the world suggest that growth is continuing to accelerate, or at least showing no signs of wilting, and that is in the developed markets. And in the developing markets, of course, so-called, they're going on perfectly fine.
I think in a valuation sense, I think the Australian equity market and a lot of equity markets around the world look pretty compelling to the extent that they're undervalued relative to other asset classes. The uncertainty that we've had over the last couple of years probably gives us pause in terms of what will happen next that will actually drive that to be fully valued.
Perennial's Adrian Mulcahy says resources and banking stocks are the best local bets in the year ahead, and he also likes companies exposed to the US economy like News Corp, James Hardie and ResMed.
If we saw an improvement in the US economy and the currency itself retreated to more fundamental levels, there's a bit of a double hit for those companies themselves back into Australia, such that they actually will be potential outperformers. But the underlying conditions are obviously key to that first part of that process.
Magellan Financial Group's Hamish Douglas is also upbeat about America's prospects and thinks officials there have the right policy prescriptions in place. But he thinks the best value is still to be found in developing economies.
We think the emerging market consumption story, so big consumer companies servicing these consumers in emerging markets, we're very, very positive on that story. We're very positive also on the e-commerce story around the world, because we think that is going to be a real growth engine.
However, Platinum Asset Management's Kerr Nielsen warns that the best days for stocks in those developing markets might be behind them.
There's been so much money going to emerging markets. That's one area that I think will lose some of its following now, because yes, it will continue to grow, but the prices have moved up, prices of shares have moved up in anticipation of some pretty good prospects.
And he's also worried about Europe's sovereign debt woes, which could remain a problem even after investors and the media lose interest.
Governments have guaranteed bank debt. We're not talking about deposits here, whereas the bank debt holders should have taken a haircut. And this will just cause a more protracted problem and a much deeper problem. And ultimately, the big question we'll face through next year is how the populace live with a much more austere economic environment.
And in terms of growth, the world's a pretty tough place looking out for the next 5 years. So I think you have to be pretty choosy where you want to be in the markets if you're really looking for growth, because there's not a lot of bright spots in the world that are going to deliver a lot of growth in the next 5 years or so.
Hamish Douglass says European political stability will be a major issue in 2011, and a lot will depend on Germany's willingness to support the European Union and provide liquidity. In Asia, he says Japan remains the weakest link, while the efforts by Chinese authorities to cool their economy could mean that resources stocks are no longer a sure bet.
I think commodities in the next 18 months is actually too difficult to predict. I think it's very evenly balanced whether or not China is going to slow down or not following their massive credit expansion and property investment that's been going on. That some people would say a speculative bubble. But the Chinese authorities have to date done a very, very good job.
Those efforts to engineer a slowdown in China could also put a dampener on sentiment in Australia, which is already patchy in the lead up to Christmas. Perhaps the most vulnerable sector is retail, which already faces rising interest rates and a bigger threat than ever from online shopping, thanks to the elevated currency.
I think that probably that part of the market is a bit difficult. I think that probably the domestic, particularly discretionary retailers, and even some of the staple type parts of the market are an area where you tend to be underweight. I think that they're probably the ones that find it most difficult in this environment.
I've never known it as tough. It's really, really tough, and we have a nickname for Elizabeth Street here in Melbourne. We call it Blood Alley, because everybody's after blood. They want the sale.
While Australia's stock market, as always, remains vulnerable to the whims of global forces, domestic politics may play a greater role than usual in 2011. Banks, mining companies and Telstra have already been threatened with the heavy hand of regulation. And looming large next year is a price on carbon, which is shaping as the biggest economic reform of them all.